Okay, good afternoon. We're going to get started. My name is Liz Higgins. I'm an Ag Extension Associate with the Cornell Eastern New York Commercial Hort team. And I'm just going to put the PowerPoint up, but I just wanted to welcome you all personally to How Profitable Will My New Orchard Investment Be? So today I will be sort of managing this by myself. If you have questions, I encourage you to either use the Q&A or the chat. And I have those open on the side, and I'll pause periodically to try to answer questions for you. Otherwise, I'm going to try to also leave time at the end and I can unmute you at that point to ask questions. So type them in during the program, and then I'll unmute you if you'd like at the end if you have a specific question you want to ask out loud. So with that, I'm going to start the PowerPoint presentation. Great. So welcome once again to How Profitable Will My New Orchard Investment Be? I just want to acknowledge my overall project team for this. I'm Liz Higgins, and I'm also working with Craig Kalke with the Lake Ontario Fruit Team, Dan Donahue with the Eastern New York Commercial Hort Program, and Mike Bastow with the Eastern New York Commercial Hort Program. These are all tree fruit production specialists, and we're working together on the curricula, and they'll also be working with me at the sessions we'll be holding in person later this winter. And let me just make sure I have this open. As I said, if you just logged on, if you have questions, feel free to type them into the chat, and I'll stop periodically and try to answer them for you. I just also want to acknowledge our funder, the Northeast Risk Management Education Program, that's making this program available, especially at low cost. So the focus of this series is on decision making, and then by extension risk reduction. And I say risk reduction because a good decision, it doesn't necessarily mean you'll have a good outcome if you make what you think will be a good investment decision, because you can have bad luck, unanticipated issues. Even if you made a good decision, bad things can happen, but the best protection you have against a bad outcome is a really well-informed good decision. So my goal is to help you make, good informed decisions with data that you have available and can find in your farm. Sorry, I have a little bit of a cold. The purpose of this class is to give you some of the tools you need as an orchard owner to assess whether or not an investment in your orchard business makes sense, and then help you choose among potential investments. Although this class will use orchard businesses as the framework, most of the concepts I'll cover are applicable to any business situation, especially in these webinars. I also do have to be clear in these trainings that I'm trained as an economist, not as an accountant. So some of you may have accounting questions that are totally above my pay grade. And although I've had some accounting classes, I know enough to know that accountants have ways of doing things and best practices around financial records that allow for, consistency and transparency. And it's really important, especially for external audiences like bankers and the IRS. But what's important is, as managers, you also do have some additional flexibility to use your own financial data to help you make internal decisions. And that's really what this class is going to focus on. Over the next 8 days, we have a series of short webinars that will cover specific content. I'm trying to break things down into manageable chunks. All of these webinars are being recorded, so if you miss one or if there's something you want to go over again later because you just can't get enough of watching me on video talking through PowerPoint, they will be recorded. There's going to be a lag though, so it may be a few days before I get them up, but you will be able to watch them later. And then this winter, we're having hands-on workshops. There will be 2 in Western New York and 3 in Eastern New York. And this second part of the program is an opportunity for you to attend a one-day hands-on workshop where you get to work in a small group with others to apply some of these tools to a farm scenario. So you'll be given a set of financial data, and you'll work with your group to answer questions about the farm, to look at potential scenarios and make decisions about what options seem viable or not. And this will hopefully help you learn techniques that you can use in your own farm business. So these are intended to be, a chance for you to really like dig in there. It will be less me talking and more you and the group you're working with sort of working through different business options. So I hope it'll be fun. I think they are $25, so you get a free lunch. You'll get resources you can go home with. And so I'll give you some Excel templates to sort of run some scenarios with. And yeah, and hopefully, it'll be a chance for you to be able to dig into things more than you can just sort of watching a webinar. And part of the reason for this is I find a lot of times I'll watch something, I'll be like, oh yeah, I know how to do that. And then I go and try to do it and I'm not really sure. So this is a chance sort of for you to like really get your hands dirty, if you will, to try to actually do some of these things in a very sort of low risk kind of environment. So let's get to this session. In this session, we're going to take a step back and have you use some of the tools you probably already have to help you evaluate your farm's big picture sort of financial situation. And this will help you assess what types of investments are likely to be viable for your farm business and whether you're likely to be able to use credit to finance that investment or to help you sort of think about maybe some areas that could be of concern for your business. So this is sort of the first cut that many businesses would take if they were really thinking about doing something different. So today we're going to cover how to use your farm's big three financial records, and that would be the balance sheet, the income statement, and the statement of cash flow to assess your overall financial situation. And I'm going to try to help you understand and interpret the data that's in these standard financial statements. These are records, that a bank or other lender or investor will probably look at first to get a sense of how your business is performing and how you compare to similar businesses. I do want to say I am making the assumption in this class that you have access to these records, maybe from your accountant, or maybe you prepare these yourself. So there's going to be a lot of detail about these records and best practices for keeping and maintaining these records that I'm totally going to gloss over. So if you're new to farm financial record keeping, I highly suggest, taking a course specifically on record keeping, and there's tons of resources online. In addition to extension, small business development centers are located in most counties, and they also offer classes and technical assistance in this type of financial management. So there's a lot of resources for you to get this information. But to get started, just so I have a sense of who's in the room, I'm going to put up a quick poll so I kind of get a sense of like where you all are with these. So you should see this now. And the questions are going to be, do you use financial statements? Do you, to evaluate your farm business? And does your farm prepare annual financial statements? So you should see this poll. And this will just give me a chance to see like sort of who's in the room and kind of what kind of experience you have. I'll give it one more sec. Good. Well, it looks like most of you have financial statements, which is great. So I'm preaching to the choir with some of this stuff. That you use them already on some level to make financial decisions about your farm's performance, which is also great. You're somewhat, most of you are somewhat comfortable about doing this. So a lot of this may be familiar to you, and that's also good. So hopefully there'll be something new, but if not, it's always a good refresher. So the balance sheet, I think most of you should know, is a systematic listing of all that the business owns, its assets, and all that it owes, its liabilities. And the key thing is at a specific point in time. And it's also sometimes referred to as a net worth statement. It doesn't show if your business is profitable, although a profitable business would be expected to have an increase in equity over time or net worth. It doesn't actually measure the profitability of your enterprises, because your assets can gain and lose value totally independent of the performance of your business. Think about like skyrocketing land values, which can skew your equity. Also, the withdrawals of equity from the farm business, that you take out for a living, or maybe for other investments, can affect your balance sheet, but it doesn't mean that the business activity isn't generating a profit. So completion of the balance sheet does provide answers to 3 critical questions that face farm managers and owners. What do you own? What do you owe? And what's the difference? These days, assets, which are what you own, are divided generally into 2 main categories: current assets, and those are the items that are either are currently in cash or will be converted to cash within the next 12 months, or could be easily converted to cash within 12 months. And non-current assets, also sometimes called long-term assets, are those things that have a longer than 12-month period that you would use them before they would be turned into cash. That would be your equipment, your land, trees if you're an orchard, that sort of infrastructure. And generally your non-current assets are the what you are actually using to be productive in your farm business. Liabilities are the debt, short-term, and once again, they tend to be divided into the 2 categories. Short-term current liabilities are debt that you will owe in the next 12 months, or bills that you have to pay within the next 12 months. And long-term liabilities would be liabilities like a mortgage or loans where it extends beyond a 12-month period. And then assets minus liabilities is your equity or your net worth. So this should be fairly familiar to most of you all. So what can we learn from our balance sheet? The big thing that is covered, with a balance sheet is one of the ratios is liquidity, and liquidity is the ability of a farm to generate sufficient cash flow for living, taxes, and debt payments. There's 2 common liquidity measurements that you can get from your balance sheet, and that would be the current ratio and working capital. The current ratio is your current assets divided by your current liabilities. So it's the assets that you have, as I said, that are cash or can be converted to cash within 12 months easily. So it could be, inventory that you have in storage. It could be crops that you're going to sell. And that would be divided by your current liabilities. And that would be the debt that you owe within the next 12 months. And so I'm with a lot of these ratios, I'm gonna give you what generally is considered to be like, when you do the ratio, what the number that you get would give you some sense of like whether you're doing well or whether you should be concerned. But I definitely want to caution you that these are just sort of like rules of thumb, and I mean, you all know from a balance sheet, I mean, it's only a single point in time. So if you happen to run that balance sheet like right after you got a big bill, and like when your checking account was really low, it doesn't mean that there's a real problem. It's just that point in time. So that's why we always recommend running balance sheets at the exact same time every year, so that we sort of control for that seasonality of your cropping year and your cropping season. But also recognize that these ratios are individual businesses may have slightly different ratios, and they're also somewhat dependent on you including all of your current assets and all of your current liabilities, and to the extent that your financial statements may be missing some things, your ratios could be off. So the other thing I would say is, for your own business, doing things, as long as you do things consistently and you always calculate your ratios the same way, they may not be as comparable to other businesses, but they'll always be comparable to yourself, and you can sort of track, how you're doing over time. So that's something. So even if it's not 100% perfect, at least like internally, it would be something that you could use to sort of judge how, how your liquidity ratios are going and things like that, and give you some information for your own business. Working capital, a lot of people talk about having working capital, and that is your total current assets subtracting out your total current liabilities. And working capital is not a ratio, it's just a number. So, so it's going to be very different for every farm. A really small farm, might have like very little assets and no debt. So it's going to have, more, maybe a small amount of working capital. A bigger farm could have a lot of liabilities and a lot of assets and, have a very different number for working capital. So one way that they can, you can convert it into a percentage or something to make it a little bit more comparable, to give you a rule of thumb, would be to take your working capital and divide it by farm annual gross income. And the rule generally accepted ranges, with the same caveats I just gave you, would be if it's greater than 30%, that would be, strong as far as having working capital. 10 to 30% could be in the caution range, and less than 10%, it could be that you're vulnerable, that your liabilities seem to be really high compared to your assets. And so, that it might be something that you could be concerned about. So the other thing is that with the current ratio, I just also wanted to say, to interpret the ratio you get, is if you had a current ratio of like 1.76 when you did that, that would mean, the way that you would interpret that number is for every dollar of liabilities, you have $1.76 in current assets in which to pay them. So if you had a current ratio of 90, that would mean for every dollar of current liabilities, you have 90 cents in current assets to pay it. And that would be of concern because you're 10 cents, underwater. So that would be, the way that you sort of would talk about that ratio. So when we say that greater than 2 is strong, that would mean for every dollar in current liabilities, you have $2 in current assets. You have $2 in the bank essentially to pay that dollar in debt that you have, current debt. So, the thing is that, you can do different things as far as how it would affect your current ratio. So, current ratio is all about short-term short-term assets, short-term liabilities. So one option is if you refinance your short-term loan into a long-term loan, that would increase your current ratio. Because you're moving things out of the short-term liabilities, you're pushing that, that debt, that further down, kicking that can down the road. It has no change and it also would change your working capital because you often, when you have a longer term loan, you are stretching the debt payments out over a longer period of time. So if it increases your current liability, is that a good thing? Well, if you refinance short-term debt into a longer-term debt, like a non-current liability, that, it will improve your current ratio, and that could be good, and it could make, your life more comfortable for a while. But it's also really important to look at the situation and the reason that the short-term debt is so large and needs restructuring. So, for example, if this was due to a infrequent something that happened, like you got hail and you didn't quite have enough money, and so you had to take out a short-term loan in order to cover that, and then you refinance that into a long-term, USDA emergency loan, that would be like, but otherwise your business has been very profitable. That refinancing would be really a good thing because the longer-term loan would have a lower interest rate. It would be probably a better situation for you than that short-term emergency loan. And that does not indicate that there's a business problem. On the other hand, and I've seen this situation in the past where you have a operating loan that's been growing over the years because you just haven't generated the profits, or you've had like really high costs and your costs have like been, like eaten into your profits. It hasn't been sufficient to provide your living expenses, pay the taxes, service the debt. And this liquidity problem is just a symptom of another problem. If you refinance this operating loan with a longer term loan, that's just temporary relief, but it's not a long-term cure to your fundamental problem. So it's the same situation. In one case, it's a positive thing for the business. And another thing, it's just sort of a strategy that might be, really a longer term, sort of fundamental issue with the business. Similarly, selling a long-term asset to pay off current debt also increases your current ratio. So that's, generally a good thing. Increases your working capital. Now you have some more cash. But that's another situation where, if that long-term asset is, say it's a piece of equipment you're no longer using, it's not productive, and it's something that's not really contributing overall to the profitability of your business. Selling that long-term asset, paying off current debt, and having more cash flow is probably a really good move for your business. On the other hand, if you're in a situation where you're selling a long-term productive asset, a piece of land, a piece of equipment, because you have such pressing current debt that you have to take care of, that could be, once again, a more fundamental problem to your business that, indicates that there are other structural issues with your business that you need to address. Another measurement that you can use using your balance sheet is looking at your solvency. And solvency is by definition the ability to pay off all of your debts if the business is liquidated. And lenders, for example, are going to be very concerned that, if you borrow money and for whatever reason you can't pay, that, you do have the ability to, that they could repossess everything, sell it and get their money back. And there's a couple of standard solvency ratios. I specifically want to talk to you about debt to asset ratio and equity to asset ratio. Debt is really useful tool for a business. I'm sure most of you use credit in your business at some point, and it totally makes sense because having debt, borrowing money allows you to get, control more assets. And, presumably those assets are productive and add to the profitability of your business than you would if if your equity was financing all of the assets. So, using debt strategically can really help a business grow, but debt comes at a price. In the case of borrowing money, that price is interest. And there are times when interest is really reasonable. I mean, we've been through a period where interest rates have been historically really low. And so borrowing money in that situation, makes a lot of sense because you're basically leveraging somebody else's money. And if you're earning more money on what you've borrowed than you're paying in interest, that's generally a good thing. But if you borrow a lot of money, you're quite vulnerable to interest rate changes. So if you were borrowed at a low rate and it's a variable rate and now the interest goes high, what was an affordable loan might not be an affordable loan anymore. And if you have too much debt, and your assumptions about income coming in to cover that debt are off base or something else changes, you're on the hook for having to pay that money back also, and that can be a concern. So it's really important to know your debt to asset ratio and look at the trends of what it's been doing over the years. Because that can affect your solvency. So debt to asset ratio is very simple. It's the total debt that you have, your total liabilities divided by your total assets. And generally, if you're less than 30%, it's strong. So if the debt that you have is less than 30% of your overall assets, that would be considered to be good. 60 to 30% is in the caution range. I mean, a new business, a business that's expanding, could be in that range, and that's not necessarily an indication that there's a problem at all. It could be a very good situation, but it means that they're a little bit more vulnerable. They're a little bit more at risk. And then once you get to like 60% of your assets are your debt to asset ratio is over 60%, that means you're more vulnerable because if your income goes down, you might not have enough money coming in to actually cover that debt. You don't have enough assets that you could sell to pay that debt back either. Equity to asset ratio is just the flip. It's dividing your equity by your total assets. The next statement I want to talk about is the income statement, and this is going to be the one where a lot of the numbers that we're going to look at as far as assessing the profitability and sort of viability of different options are really going to come from numbers that you have from your income statement. And it's really important because the income statement is what shows whether or not the farm operation returns on a profit or a loss. Profitability is defined as the extent to which an entity generates revenue over and above the expenses that it has with its available assets. Information from the income statement is also used to evaluate repayment capacity, capital investment potential, financial efficiency, which is essentially reflecting the kind of return in revenue or profit you can make from the amount you spend to operate your business. And we'll be using, as I said, this income statement information a lot in later units to do evaluation from farms. But it's also important to note that not all income, is the same, and not all like profit is the same as we go through. So, for example, some of you probably received CFAP funding during COVID, and that was income, but it had nothing to do with how efficiently or effectively you ran your business. It was more like a windfall income, and so it's important, really, when we really get into income statements, we're going to be looking very closely at the revenue from production as compared to the production costs, allocated costs, and overhead costs, because those are really the areas where we're seeing like how efficiently we're using our expenses to generate income, and where we may have some weaknesses in our business. And then once again, the classic profit formula is income minus expenses, right? It's the difference. Your profit is your difference between your income and your expense. As I've touched on, there's a lot of ways to calculate profitability, but profitability is not cash flow. We're going to talk about cash flow in another couple of slides, but a lot of times people believe that a profitable business, a business is profitable if there's always enough cash coming in. And although it's related, I mean, obviously, if a business is completely unprofitable, it's unlikely that lots of cash could be coming in. Profitability and cash flow are different. An income statement lists income and expenses, whilst the cash flow statement lists cash going in and cash going out. And the income statement shows profitability, and a cash flow statement shows liquidity, whether or not you're generating cash, not necessarily that it's really profitable or well managed. So the other thing I want to touch on before I get into the calculation formulas is there's two different ways of thinking about profitability. Accounting profits, and this is sort of the overall like net income, and this is generally how a lot of people think about profitability. It's you use your income statement information to calculate your accounting profits. It provides a view of the viability of your business. So it's just basically looking at the net income that you're generating like at any given point in time. And we'll definitely go into more in depth right now about accounting profits, but there's also economic profits, and we call these like opportunity costs. In addition to, and this is sort of the more long-term thinking about your business. Economic opportunity cost is the investment and returns you give up by not having your money invested elsewhere. So economic profits really provide more of a long-term perspective on your business, because you often will have multiple places where you can put your money, and by considering economic profits and opportunity costs, it forces you to go through and say, okay, like I can do if I decide to do this, what other things am I not doing that I might want to think about doing, and is this really the best option? And we're going to explore, we're really going to talk more about sort of thinking about economic profitability in later sessions. But I think it's really important to think that we're not just looking at whether or not a specific opportunity is profitable or not profitable. We're also asking the question, compared to what? Compared to what other options? Now let's go back to the income statement. The income statement will give you some of the following profitability measurements. It can give you your gross profit, and that's your total receipts, the money you generate from the business you're doing, minus your direct costs of production. And these are the costs directly to make every like unit of widget. If you're an apple farmer, to grow every apple. So your total costs minus your direct costs of apple production, and that would be the labor specifically used for apple production, your harvest labor, your inputs, your chemical inputs, your your fuel that you use, so it's the specific, what goes specifically into that, creating that apple. And if you stopped making apples or you reduced the number of apples, that you would use fewer costs. So the costs are directly related to the production. So that would be, and that's your gross profit margin, would be your gross profit divided by your revenue. And that gives you, for each unit that you're producing, how much profit, are you producing per unit. And this is important because if you are negative in this area, you're losing money for every single unit you produce. And you very rarely, if never, want to be in this situation. So it's really important to have a sense overall of your gross profit, definitely. But I would say gross profit is like necessary but not sufficient to be like profitable overall, because we also have what we call operating profit. And that would be your gross profit minus all of your other fixed and variable costs of running that business. Your mortgage for the overall, and it's the things that you pay for, that support the business directly, but are not based on the creating the widget. So it would be your land, some of your infrastructure that's sort of generally like part of the business. It would be your sales, perhaps, it would be your lawyer fees, your crop insurance, or maybe your liability insurance overall for the business. Those are your sort of your overhead expenses. So that would be, that would give you a sense of like, not only what does it cost me to sort of grow this apple, but what does it cost me? Am I still profitable when I'm sort of maintaining this entire ecosystem that is this farm? And so if your operating profit, the operating margin then would be your operating profit divided by your revenue. And if you are at greater than 25% operating margin, that would be considered strong. 25 to 15% is in the caution range. And less than 15% is vulnerable. But once again, these are rules of thumb. It just means you might want to go in and look, to see whether it's sort of an anomaly situation, or whether you are, maybe you had some unusual costs that year, fuel went up or something, but there's no fundamental structural issue with the business. And then finally, the big kahuna is the net farm income, and that's your revenue minus all of your charges. Operating profit doesn't include taxes, one-time costs, and depreciation, because those are sort of, those are not central to you. You pay taxes aren't anything you really control as far as running your business. You just sort of like, they're this add-on fee on top of it. You might have like a big one-time cost that's not really central to running the business. It's something that you need to account for in your net farm income, but it's not part of the operation or the creation of that specific apple. And that's why it's subtracted afterwards to show net farm income. And then your net profit margin would be your net farm income divided by your total revenue for the farm. So you can see, like, at each level, it gives you sort of different information and different levels of information about your farm. And your goal for your farm business is really to have positive, net farm income and a net profit margin, because that means you're accounting for all of the expenses of your farm business, not just the widget that you're creating, not just the widget plus the overhead, to maintain the farm, not the widget, the farm, and the taxes. You're covering everything, and you're still making money, and that's really the ideal situation for a farm business. And yeah, so that's, those are sort of the big three profitability numbers that you tend to generate from income statements. You can also use your income statement and your balance sheet to generate two other ratios: the rate of return on farm assets and the rate of return on farm equity. And that would be your net farm income divided by your total assets. And that's sort of thought of as the interest rate your farm earned in the past year and all the money invested in the business. And then rate of return on farm equity is sort of the same idea. It's the net farm income divided by the total equity you have in the business. And that's your, interest rate, your net worth in the business earned. Yeah, so your investment in the business earned in the past year. And so, so these are, just sort of general ratios. That will also sort of depend on, different businesses will have sort of slightly more profitable or less profitable. So, I would take some of these, more as rules of thumb than specific numbers. But an important thing with your return on assets, if your return on assets is higher than the average interest rate you're paying on borrowed money, then your return on equity is going to be higher. But if it's higher than what it costs you to borrow money, then that means you're positively using debt, that your loans are working for you. But if your return on assets is lower than your average interest rate, then your return on equity would be lower. And that's a negative financial leverage, which means your loans are not working for you, that you're paying more for debt than you're actually generating in wealth and what that loan is giving you. And that would be something that you might want to be concerned about. So that would sort of, that will vary by farm because different farms have different costs of borrowing money in different situations. But these are just things, that you'd want to consider. The last form I really want to cover today would be the statement of cash flows. And this is looking at how cash sort of moves in and out of your farm over the course of a year, and also year to year, sort of what your cash situation is. And this most financial sort of recommendations are that they divide these into three categories: cash from operations, and that's the money you earn, cash coming in from what you sell, compared to the cash going out the door from expenses, in order to generate, those sales. And then they have a category, cash from investing. That's the income from the sale of infrastructure. So if you sell a piece of equipment, that would be cash from investing. But it's also the cost of purchasing infrastructure would be the cash that you use. So it's not the debt that you take on, it's the cash you use, that you take out of your checking account and write a check to buy a piece of equipment. That would be the cash from investing. And then cash from financing is the cash that you get when you get a loan, or the cash you pay out when you write a check or you do a bank transfer to pay off a loan. And so at every, and so you'll look at, and I'm going to make a bigger one. The structure of this is that you have the cash in the starting period. And then you have all the cash inflows and the cash outflows, and then the cash at the ending period. So, so you start, at the beginning, you have net operating cash, is $128,817. They brought in $509 over the course of the year if you totaled up all the cash that came in from sales. They had other income, had $172,000. That would be cash that came in. Could have been from CFAT payments. It could have been from, crop insurance payments, other cash that came in. And then these are all of the cash outflows for operating: your cost of goods sold, your operating expenses, your interest expenses, your income taxes. These are all the things to running your business. And then the net at the end of the year is $128,000. From investing, this would be cash. They sold a piece of equipment. They got $128,000. They got $28,000. They bought some equipment. They paid $40,000 in cash, not the loan, but the cash they paid. So their net investing would have been $11,000 for the year. And then cash from loans, they got $95,000 in loan money came in. They got, they had every month or whatever, they put $2,000 into the business to help grow the business from external funds. And then they had to pay the principal on debt. That was $189,000. And owner withdrawals, they took out $68,000. So their net financing was a negative $133,000. So at the beginning of the year, they had a balance of $68,000 in cash. The net change, so the 128 minus 11,000 minus 133,000 is negative 16,000. So the ending balance, you would subtract that 16,000 from the 68, and the ending balance at the end of the year in cash is 52,000. So what this shows you over time, and then you can also see the month by month sort of changes in cash. This is the statement of cash flows is very helpful for cash budgeting because it might help you decide like where you need to to maybe change the time period of a debt payment or something in order to maintain your cash flow throughout the season. But also it can indicate to you if you're constantly every year you're like lower and lower and lower in the amount of cash, that could also be an indication that you're not having enough funding coming in, because it's the cash flow helps you understand how is cash leaving the business, where are you spending the cash, and how is cash coming in. And not having cash at critical times can make it very difficult for you to pay creditors, to buy new supplies, to pay your workers. Cash is very, it's very, very important, and knowing when that cash comes in and goes out is really critical. Another sort of indicator that you can get from the statement of cash flow, and as I said, that this is really a measure of liquidity, is your operating cash flow ratio, and that would be your net cash flow from operations, which was that $128,000 we showed, that they, just from the operations. We're not considering the financing, we're not considering the investing part of the cash, just the operations divided by your current liabilities. And if the ratio is less than 1, then you have a cash crisis. You may have a cash crisis, because what the measure does is it looks at the amount of cash that you're generating based on your basic business operations, not money you're getting in from debt, not money you're getting in from investors, but just from like the business operations. And so it's, it really can help you determine whether or not, you're getting enough profit, you're getting enough cash coming in. And so it doesn't mean that the overall business isn't profitable, but if you have, a really low operating cash flow ratio, you might need to do something that generates more cash in the short run, because this is an indication that there could be a problem. So with that, in summary, like, why should you annually assess your financial records? It's to monitor trends in your business, to let you know whether your overall business is profitable, to provide some insight about where to look for the weak links in your business, and, to see if you have issues with liquidity or solvency and cash flow that could constrain your options for making investments and might force you to prioritize making other changes first. So for example, if you've got real cash flow issues, an investment, that isn't going to generate any cash flow for several years might not be, in the long run, that might be something that you want to do for the business. But in the short run, that could compound a situation that you already have, because that's not going to improve it in a timely, your cash flow in a timely enough fashion, maybe. So with that, I just have a couple more poll questions. And then I will go into questions. So, well, good. I'm glad, some of you know a little more, and you're a little more likely. And I apologize to the person that I totally confused. If I can, I definitely feel free, to reach out to me directly, or, any feedback about what, would be more helpful. I'm definitely open to, because, it's certainly not my goal to confuse anybody, or make things worse. So with that, let me just open the chat and make sure I have that open. Hold on one sec. Yeah, so if anybody has any questions, I can also unmute you if you want to be unmuted. Otherwise, um, we'll be back tomorrow to talk about something slightly different. We're going to really look at sort of generating your, really understanding what your business strategy is, because that will also help determine what you should be thinking about as far as sorry, I didn't even start my video. Okay, so what you should be thinking about as far as going through options for your farm. So, any questions? Oh, all right. Well, if there are no questions, I thank you for your time, and I will be any anonymous reference where we can compare ratios. Um, that's actually a good question. It really depends on your industry. If you are tree fruit, I can look, there's a lot better ratios in things like field crops and, some livestock, and that's largely because they're much more sort of uniform systems. So I can look to see if I can find anything better on tree fruit. But generally, the systems in our area are so different from each other that there are not. What we are doing for this project, though, is we're taking some of the farm business management resources that we have from the Tree Fruit Farm Business Summary and some other data, and trying to create a sort of a model farm, and that would have some general ratios, but that's probably not helpful in the short run. But if you're a corn farmer, yes, I can I can definitely point you there. Any other questions? So great. Well, tomorrow will be a little less dense, and I look forward to hopefully seeing you. Oh,